All right, we've got the Dow about 27 points, well off its earlier highs when it was up triple digits. Donald Trump's pick for the Federal Reserve, by the way, is going to be tomorrow. We're getting growing indications that he's going to have a busy news day tomorrow, certainly given that announcement. Then, of course, the details on that tax cut plan from the House Ways and Means Committee. How's this all going to factor out for the markets? To market legend, Robert Prechter, the name should obviously ring a bell to those who know. He was the man who was way ahead of the big, what they later called the Reagan bull market, but even Ronald Reagan didn't see it at the time. Mr. Prechter did. His latest book, The Socionomic Theory of Finance, is for real smarty pants who can sort of step back and see all of this. Robert, very good to have you. Thanks for coming.
Well, it's been quite a few years since I've been on television, actually, but yours has always been a quality show, and I appreciate the chance for you to slide me in for a couple of minutes.
Are you kidding? The honor is mine, my friend. You know, you see things in waves. I can get into some of the intricacies here, but the wave we've been on here has been a 9-year bull market wave from our lows, I guess, in March of 2009. Do you see that wave, or whatever you want to call it, continuing?
Well, that's why I decided to take a little bit of a risk and come on and talk to you today, because, you know, my model is the Elliott wave model. It's
right.
A fractal model of the way the market moves, with waves nested inside of waves. And I've been very patiently watching this development ever since 2009, and especially since the lows of January, February 2016. That looked like what we call wave 4. In other words, one more big wave coming. That was 8,000 points ago. So over the past few months, the past few weeks, and especially the past few days, I've been watching the developments. And here we are at a new all-time high. And the S&P 500 has reached the upper end of its trend channel, going back those 8 years, on arithmetic scale, at the same time that the Dow's met it on log scale. That's an extreme price. And, of course, there are all kinds of technical indicators that seem to be flashing some signals as well.
All right. Signals that tell you this is getting long in the tooth?
Exactly. Now, one example is the advanced decline ratio. If you take a 50-day moving average of that, do you know where it sits right now? It's kind of surprising. 1.00. In other words, on the average day, the advanced decline ratio over the past 50 days has seen as many stocks going down as going up.
Wow.
Now, early in the rally, back in 2009 to 2012, it was much better than that. So there's been a slow weakening in the upside push, despite the fact, as you know, you've been reporting on it, the Dow's been making new highs day after day and week after week.
So this is a rich market by your technical analysis.
Well, it's thinning. It's thinning dramatically. Now, there's another really interesting setup going on. Back in the 1920s, European stock markets topped out between 1923 and 1928. In January 1929, the British market topped, and in September 1929, the U.S. was the lone market sitting up there all by itself. We've got the same thing, but on a much bigger scale today. Back in 2000, the European stocks topped out. They've been languishing ever since. In 2007, China topped out in its stock market. Now, that's 10 years ago and 17 years ago, and here, the lone blue chip in the world, the United States stock market, is at a new all-time high. I think it's very reminiscent of that prior time.
So which leads which? I mean, you're famous for saying, you know, markets don't, or economies don't lead markets, markets lead economies. I think I got the gist of that right. We're already getting signs out of the Eurozone that things are slowing a little bit. China, economic information that kind of echoes that. So what are we seeing?
Well, recently they reported 2 quarters above 3% growth here in the United States. And a lot of people are saying this is a liftoff. But as you just pointed out, the economy lags the stock market. The stock market is known as a leading indicator, always has been. So it's not going to top out when everybody says, oh, there's about to be a recession. It usually tops out when times are good and people are feeling good. And the last issue I just put out of the Elliott Wave Theorist showed 35 charts of sentiment indicators showing either record optimism based on that measure or near record optimism based on that measure. So people look around and say, oh, people are worried about politics, or they're worried about North Korea. But when you look at the sentiment indicators, not only in the stock market, but also in the bond market, you find record complacency or near record complacency everywhere you look. That's another sort of background indicator that I like to see if I'm going to try to come out and say something about the market.
So what you're saying, Robert, is people are getting a little ahead of themselves. They're a little too giddy. There aren't enough bears out there. When everyone seems to be so bullish, or everyone's piling into the market at the same time, that gives you pause.
Well, it's a little different from 1999, 2000.
Right.
And as many people have pointed out, you know, everybody was watching financial television in the taverns and the doctor's offices, and they were buying penny stocks. The public was very excited about things. That's not the case now, but there's a different kind of complacency. What the public is doing, in fact, to a record degree in the first half of 2017, is to move money out of actively managed funds into these passive index funds. So they're now convinced that if they just put their money in index funds, they can retire happy and there'll be no problem. Back in the early 80s, there was 5 times as much money invested in money market funds as there was in mutual funds, stock funds.
Wow.
Today, that ratio's flipped. 5 times as much money in stock funds as money market funds. These are just a few of the extremes going on today.
So are we in for a crash?
Oh, I don't know exactly how it's going to develop from here, but let's take a look at one long-term indicator, the 200-week moving average of the percentage of bears reported by Investors Intelligence. That's at a new 50-year low. 50-year low in the percentage of bears. The last time it was a little bit lower than this was 1966. And that's when, as you know, the market started a 16-year sideways period in nominal terms.
Right.
And during that period, of course, in real terms, it was going down substantially more than 70%, which was the biggest decline since 1929-32. So these extremes mean something. It doesn't necessarily mean I'm going to come on, at the top day in the market, even though I think it's a great day to be talking to you because we have new all-time highs in the averages, and it's a Fed day. So people aren't going to be paying attention to this. They're paying attention to the Fed meeting, which is nice for me. But they are very meaningful looking out, long term. People say invest for the long term. Well, these negative indicators, I think, are saying something about the long term. You need to be cautious.